Treasury Secretary Janet Yellen notified Congress on Monday that the U.S. could default on its debt as early as June 1st. Now, that is if regulators do not raise or suspend the nation's borrowing authority. And here to talk about this with me is Mark Hamrick, Senior Economic Analyst at Bankrate.com. Now, I understand a lot of analysts agree that it's unlikely to happen that the U.S. will default on its debts. But I just want to know, practically speaking, if it does happen, how would a default directly impact regular folks like you and me?
Well, it would be an economic catastrophe. I think that is a given, and how that sort of presents itself involves the fact that the government is responsible, the federal government in the United States is responsible for a lot of economic activity, does a lot of business with other businesses, as well as, of course, supplying funding to individuals, whether it's members of the military, federal government employees, to Social Security recipients, and provides health care to people who are senior citizens as well as those who are poor. So you can imagine the impacts where you take out a huge slice of economic activity all at once. And there are also the mechanisms that are involved with, for example, treasury bonds, where treasury bonds are part of the backbone of the global financial system, where countries all across the world invest in these instruments, and they are, of course, getting some return on those investments. And so the government needs to be able to meet all of those obligations. And the looming X date is when the government can no longer fund all of those obligations, and that's quite significant. It's never happened before in the United States.
Was the United States late for a few days on its debt in the past?
Well, we breached the debt ceiling previously, but we did not meet the so-called X date previously. We got very close. And so that was in 2011. And, I think what most of us focus on here is that this is something that's self-inflicted. The debt ceiling does not do a good job of restraining federal spending. That's quite clear when you've got $31 trillion plus of debt. So it's an ineffectual tool, and it only raises the risk that we're talking about right now. And to the degree that it might eventually compel Republicans and Democrats to restrain spending or bring down that level of debt, that, of course, is what people are essentially hoping for at this point. But it's a little like using a sledgehammer to commit surgery. It's too much, and it's ineffectual.
Well, what do you think then would be a better way?
Well, the better way would be for the government to present a balanced budget on an ongoing basis, or in the rare instances where having more federal debt, or what I should say, in the rare instances where the government needs to use debt to fund its operations, that be a temporary procedure rather than something that has in recent years become more permanent. We have balanced the budget in the U.S. in the past. It happened during the Clinton administration. It happened again during the Obama administration. And it's only really been in the last decade or so where we've had to sort of have this problem. So, I think that there's immense political pressure on Republicans and Democrats to avoid this kind of a catastrophe. Obviously, the president is now willing to speak with the Speaker of the House as well as others, and the hope is that this can be avoided so that we don't have a severe economic event here in the United States, which would ripple across the globe.
And what would that impact be around the globe? Would it cause a global financial crisis?
I think that is an assumption that most people are making. Of course, the problem is that, like a lot of things, this hasn't happened before, and so we don't know exactly how it presents itself. But let's look at, for example, what's happened here over the last number of weeks with the failure of major banks. We're just talking about 3 of the 4 top bank failures in U.S. history. And that alone is thought to be pushing the country closer to a recession because of restrictions in lending, that lending's being pulled back and there's less demand for loans and less supply of lending. So in that case, we're talking about really a less than a handful of financial institutions. And remember, during the Silicon Valley Bank failure, one of the things that compelled regulators to come to the rescue, so to speak, was that there was a fear that a large number of businesses would not be able to make payroll on that Monday morning, meaning that a lot of individuals wouldn't be getting the paychecks that they were expecting. Well, imagine magnifying that so many times over with the federal government unable to pay its obligations. That's really what we're talking about, and that's just a small slice of the kind of trouble that we'd be talking about. So you would imagine in the event that the government were to go all the way up to this X date without raising the debt ceiling, that there would be a great deal of disruption in financial markets, declines in stock prices, a lot of disruption in the ability to obtain credit. And all those things would be quite devastating for the economy. And remember, we're talking about economies around the world that have been struggling in the face of high and sustained inflation. So we're really courting additional trouble here if indeed this were to happen.
Right, this is a very serious topic. And as well, the Treasury Secretary yesterday warned against leaving this to the last minute. I wonder, what do you think would happen if there is an impact leaving it to the very last second?
Well, I think financial markets become more and more uneasy. We're seeing some of that, I think, right now, as a matter of fact. And so the deeper we get into this without some resolution, the more disruption it causes both in business and consumer behavior, because, sentiment is important. You have to have confidence, whether you're a consumer or a business. And the behavior of financial markets is, of course, something that even for those who are not significantly exposed or invested in the stock market, still affects consumer confidence, and business confidence goes along with that. So, the more time that is essentially wasted, the worse it gets.
Would it impact the faith and credit of the United States?
Well, that's really what we're talking about, right? We're talking about an institution, the United States federal government, having previously been seen as immensely reliable in the ability and indeed the behavior of making good on its obligations. And so for that streak to be interrupted would be something that damages the credibility of the federal government.
And she also said something along the lines of raising short-term credit costs would have an impact on that?
The presumption is that that borrowing becomes more difficult and more expensive. And, we're seeing what's been happening with the U.S. economy, with the Federal Reserve raising interest rates since March of last year. And that is something that has been, more of a steady increase rather than something that's inflicted by a financial crisis. So, you can imagine that all kinds of business activity and consumer activity gets interrupted in that event. And that's why it's something to be avoided.
Now, just one last thing. The likelihood that the U.S. will actually default is very low, is it not?
That's what we think, but the problem is that we're talking about humans and we're talking about elected officials, and all of those entities, meaning humans and elected officials, are imperfect. And we've gotten to this condition that we're at right now through totally unnecessary means, meaning that the government has failed to raise the debt ceiling here once again, meaning members of Congress, and the president needs to negotiate with them, presumably to some degree, to get to a resolution. And we're just hoping this doesn't happen.
Yeah, let's hope not. I mean, it would be disastrous. But thank you so much today for talking with me, Mark.
Thank you.
The Treasury said Monday it plans to increase its borrowing during the April to June quarter of this year.